Hello, everybody, and happy International Women's Day, and a warm welcome for those joining us today. So welcome to this event, particularly this Evenco events in partnership with Bloomberg Intelligence, which is a great partnership with many upcoming events, so stay tuned. So yes, my name is Adeline Diab, and I'm Director of ESG Research within Bloomberg Intelligence. So Bloomberg Intelligence, as a brief introduction, is the research powerhouse of Bloomberg, with over 400 analysts globally covering credit, equity, equity strategy, credit strategy, and of course, ESG. So we have a fantastic day planned ahead, a fantastic panel to discuss, again, this three letters, ESG, and how it is reshaping capital market today. So with us today, we have three leading ladies, each with different roles and perspectives. So first we have Hanna Olsson, ESG Director at CapMan, Sarah Goose, Portfolio Manager, Responsible Investment Lead at James Hambro and Partners, and Hanna Edström, Executive Director and ESG Lead at LGT Capital Partner. And so before going into the core topic, I'll take a few minutes to maybe shape the conversation or set the stage for where we are today. So obviously we all know that ESG has gained a lot of traction, in particular over the COVID years, with rapid growth in AUM, over 20 to 30% of global AUM today. It's definitely not a boom and bust trend as some may have thought a decade ago, but it's here to stay. It has moved from a fringe concern to the mainstream, and now increasingly, or now actually becoming mandatory. And this is why it's probably the most disruptive trend reshaping capital market today, as much as the internet disrupted capital market perhaps a few decades ago. And obviously we have this growth has raised a number of questions, and given the global economy, geopolitical stability, climate emergency. And so today we'll discuss a few of those questions. So first, to kickstart the discussion, I'll turn to Sarah. And so I guess after 2 years of COVID, and then now a year on since the unfortunate Russian invasion of Ukraine happened and a war at the doorstep of Europe, have ESG, in your opinion, and became secondary?
Thank you, Adeline. Well, hopefully not, given all of our respective job roles and interests. But I think you summed it up really well when you said that it is becoming mainstream. So I don't think that perhaps ESG is becoming less secondary, but more that it's becoming further integrated into mainstream thinking. This does, however, very much depend on one's definition of ESG and also how it's used. So, for instance, our approach at James Hambro and Partners is very different to that of a passive investor. But whether it be COP26, COP27, COP15, the growing awareness raised by the twin crises of climate change and biodiversity loss, or the increased recognition that businesses and individuals cannot afford to ignore inaction any longer, this awareness of the interrelated nature of the various aspects of the E, S, and the G is not just limited to climate and biodiversity, but links are becoming much more obvious between perhaps climate progress and female education, social mobility, human rights, etc. So we can't view these aspects in isolation. I'd actually always hoped that one day we might lose the ESG acronym as the considerations of environmental, social, and governance factors become just part of the norm when we invest. And the events of the past few years that Adeline very, very rightly highlighted, that brings us further into the spotlight. I think companies and governments certainly have much more of an increased focus on elements such as supply chains, and that's helped us as investors gain much further transparency into environmental standards or working conditions. And the fact that linear models are often able to be disrupted by increased circularity that saves time and costs. So if anything, I think ESG and responsible investing has become more sophisticated. stewardship practices have become much more developed, and engagement with companies has become much more fruitful. We've found at James Hambro and Partners that in many of our recent engagements with sustainability specialists or IR teams, that we're actually very keen, and they're very keen to have this transparent and open dialogue with us, which is really helpful. And we get a huge amount of understanding of the company's ethos and its culture, much more so with these meetings than we do when we're just talking about fundamentals or company strategy. So I think it's healthy to have this debate over ESG, but I don't think it's going anywhere.
Thank you, Sarah. And I could not agree more. And I guess those challenges over the past few years have probably more so ingrained ESG within the industry and how it's now part of really fundamental risk analysis. Thank you. And I guess staying on probably a recent event, and if we turn, for example, to the US, where we see on one hand, the political backlash against ESG, yet on the other hand, the IRA and fueling investment in the green transition. Hanna, may I ask you how this environment, or does this environment has any impact for the buy side in general, for investors to cherry pick funds, for example, or stocks?
Yeah. Thanks for the question, Adeline. And I actually think it does. I fully agree with what Sarah said before, and also the picture you gave to start with, and also especially being based here in Europe, you really feel that there's a lot of momentum, and if anything, ESG is only gaining and gaining on importance. But then if we look at the US, I think it's a bit more of a mixed picture. And we all know that we have states like the Texas, Florida, Oklahoma, where there is more of a push against ESG. And we even heard the governor of Florida, DeSantis, say earlier this year that ESG is banned in Florida. So those are quite strong statements. And I think for a while we felt that it was not really affecting what we do, but actually this year we have now started to receive kind of reverse ESG questionnaires. And I think that's the first time that we have really experienced that, where you have looking as a traditional ESG questionnaire, but really where they're asking you if you have any engagement with net zero organizations, if you have set any targets, how you're engaging with companies. They also give specific examples of companies, asking if you ever had dialogues trying to block oil investment, oil and gas, and so on. So I think that is a new development that we are experiencing. It's still quite a small part, I would say, but it still gives a bit more of this mixed picture, where on the one hand side we have this very strong growth here in Europe, and for the US a bit more mixed.
Thank you, Hanna. And maybe given and if possible, briefly, I guess, since it's a little bit more on geopolitical side, but Anna, if we turn to you, based in Finland, with a border, for example, with Russia, and then a very obviously heightened geopolitical risk today, what are other impacts than such geopolitical risk has on ESG investing, for example, or investing in general? For example, we saw how inflation or how the war at the moment had impact on inflation, which obviously made it impacted the green transition. So does such environment make it acceptable to invest more in fossil fuel? Any thoughts?
Yeah, thank you for the question. It's a very good question. I think for us, the current geopolitical situation, or Russia's war on Ukraine, it has really highlighted the need for not only risk awareness, or ESG risk awareness, but also the need for a clear strategy around ESG and what it is that we want to accomplish. So we're a private markets actor. We invest in companies and properties in the Nordics. And we're often majority investors, and we're also active owners. So of course, this when something happens, it affects us quite a lot. And I think the main thing that affected us across the board was, of course, the increase in energy prices. But more specifically, we had a transportation company, for example, that purchased diesel from Russian sources. And of course, with the sanctions coming in, we had to cut that and address that immediately. For that specific company, and in general for our portfolio, we are transitioning our portfolio. So for that company, the plan was to transition away from fossil and move to an electric fleet. So for us, this more highlighted the need for the actual transition towards renewable energy mix and emission reductions. So not a move towards fossil, but rather away from it. And we invest in infrastructure as well. And then there we do both transport, where we transition to electric, and then green energy, so wind farms, solar farms, and these things. So for us, that was really the more of a highlight that this is
acceleration
to go. Yeah.
Towards the green, which is very fair enough, and I think highlights, again, how these events are probably catalyst, although disruptive, but ultimately catalyst for ESG investing. And so, if we now turn more specifically in practice, each of you work in different institutions, a private equity fund, more of an asset manager, a fund of fund company. So may I ask, maybe starting with you, Sarah, how are you integrating ESG in your investment process?
Yeah, thank you. So we, James Hambro Partners, we're a small medium investment manager for private clients, predominantly charities, trusts, and also some international clients. Our focus is predominantly on global equities, but obviously we provide a balanced portfolio, so all asset classes need to be considered for us. Thinking specifically about equities and our equity investments, we keep the ESG together when we think about this as a group, but it very much forms one pillar in our analysis alongside the fundamental analysis we do on direct stocks. So for instance, we have a 5-pillar framework where we consider 5 different elements of ESG factors, be it circular economy, biodiversity, social and stakeholder involvement, governance or decarbonisation. So there's lots of different elements that we analyse companies under. And we bring this all together alongside the fundamental analysis, the valuation analysis, and also conversations with management where we want to ensure we've had that sort of looking into the whites of their eyes before we can invest private client capital. It's really important for us to consider everything in the round to ensure that we're capturing all aspects of a company into our offering.
Thank you, Sarah. And Hanna, turning to you. So how do you embed the ESG, and even if you have any view on across asset classes or the different reality between asset classes?
Yeah, absolutely. So we are at LGT Capital Partners, we're a global asset manager, but we're also principal investors. So we have what we call an endowment fund that sits in the middle of everything we do. It's a almost $20 billion fund, and similar to the endowment funds in the US. So quite a high allocation to private markets, also hedge funds, alternative assets, and partly invested in liquid assets as well. So in the past, we very much integrated ESG into the different parts of the portfolio. But a couple of years ago, we also decided to put a framework in place that governs the whole strategy as well. So we put top-down goals as well. So what we look at, for example, on the overall portfolio level is to have a solid ESG profile. So we have different methodologies of rating the different parts of the portfolio, depending if we invest in an external manager. We have one methodology of rating the managers, or if we invest directly into listed equities. So we have our own in-house tool to rate that. And that all flows into one overall ESG score then for the portfolio, where we have now set a certain limit that the overall portfolio has to be above that score. So that's the first part, the overall ESG score of the portfolio. What we've then also included is a net zero target. So we've set a net zero target 2050 or sooner for the whole portfolio. And we work with what we call a budgeting framework. So for all different asset classes, we have set a certain budget. And as you know, we know what the emissions are today and we know where they have to go. So this budget is then constantly decreasing each year. And in that way, we can really measure within each asset class and also down to certain companies to see if they are within their budgets. That doesn't mean that we would exclude anything that is above budget, but overall for the whole portfolio, it has to be below budget. And we've also set frameworks how to invest more in green assets, so also to support the transition. And the last part of this framework is then also active ownership, that we want to be active within engaging with directly with firms, but also with our external managers and also in the whole financial world. So for example, we have a board seat on one of our managing partners has a board seat on PRI. So being active on those different levels.
And you said something that I think is almost a motto at Bloomberg, but you can't manage what you can't measure. So setting such target is very helpful, and to keep a cape. And I guess turning to you, Anna, more as a private investor, so the reality is slightly different, the investment process as well. So how do you embed ESG from due diligence to contractual forms and other and influencing? Could you walk us through that and maybe highlight any big success or challenge you may have encountered in doing so?
Yes, I think we have both challenges and successes. I'll try to do that. Well, we integrated from DD throughout all the way to exit, both for our properties and for our portfolio companies. And we have tools to help us systemize this approach. So some things will be the same across the board, but properties on the one hand, right, and then portfolio companies on the other hand, they're slightly different. And we only invest in Nordic companies and properties. And this, when it comes to legislation covering ESG in the Nordics, it's quite decent. So that means that the companies are quite well governed to start with. So we were able to actually push them a little bit more, and also to think about creating value with ESG. So we are setting targets that are specific for all portfolio companies. We're setting very specific targets for all of our properties covering ESG. Something that we have across the board is we have committed to science-based targets. So we are now helping our portfolio companies to set their own science-based targets, and we are aligning our entire property portfolio with the 1.5 degree scenario. And then we also want to, across the board, regardless of what we invest in, promote happy workers and satisfy employees. So we measure we measure employee satisfaction at our portfolio companies, and we push for a positive work culture. And we also put an extra focus this year on diversity and inclusion, because we see the benefits from that. And then to get this on the agenda, and I think this is might sound small, but I think this has been a big success for us, is that we tie executive remuneration to sustainability targets. We do that at CapMan, but we will also do that for our portfolio companies. And then when you tie it to money, it gets done. Because of course our portfolio companies are growing fast, and we're often the first institutional owner. So there's a lot of things to get done. So making sure that ESG is put on the agenda is a good way of doing that. And I agree with what measures gets done. So we have around 86 ESG KPIs that all of our portfolio companies report on. And for the properties, we have the needed data points that we gather from properties as well. And then, of course, so there are a lot of things that we can do systematically across. We have discovered, a bit surprising, but then, of course, as we work quite closely with the companies, it's important to identify what is actually material. We're sector agnostics, so we can invest in a hardware and a company, and we have an elevator company, we have a software developer, we have bus companies, so it's very diversified, our portfolio. So it's about finding out what's material to those specific companies.
Industry.
Yeah, and then we set targets on them. We help the companies setting targets on the material aspects as well.
So moving the conversation more towards ESG and something or a topic that has come back and maybe driving some of the narrative in the unfortunate narrative in the US, which is ESG and returns. And so Anna, sticking with you, since you were going there, but basically any example where you highlight how to evidence how ESG is about maybe creating value or preserving value when investing in the private world, in the private side, which is which is obviously not listed, so it's a different reality.
Yeah,
and where ESG may matter even more, actually, yeah, for value. Sorry.
Yeah, I think within our properties, the link is really clear, because if we can be more efficient with the energy use, if we can put those measures into place, if we can renovate a property, then we can see the benefits quite clearly. Same with circularity. We have that type of approach where we don't need to go and buy new material, but can recycle what is already there when we rebuild properties, for example. Those benefits are quite clear to us.
Thank you. And maybe turning to you, Sarah, what is your perspective about the sentence that we may have heard about ESG meaning or potentially meaning sacrificing return? Is it in the narrative to individual clients? How you present that side of the question, or how you answer it or address it?
Yeah, it's a great question, and it is no doubt one that we've encountered, given that our end client is they are private clients and individuals interested in the narrative, that read in the news and want to understand what our integration of ESG and our voting and our engagement, what that means for them and for their portfolios and their capital. But in the last few years, we've seen a step change and an embracing almost of the sustainability and the inclusion of these sort of metrics in our analysis, because many people now realize that by analyzing these certain attributes in companies, it's a good practice to do. It helps us to understand which companies are going to be around in the next 10, 20, 30 years, because they're thinking about the problems that are facing us down the line. And they're integrating them into their business models. So I think the narrative has shifted around what individuals will come and speak to us about. And when we talk to lawyers, perhaps, or accountants, it is very different. It's less of this stigma, or gosh, you're integrating something that we don't properly understand yet. There's very limited data, to something that is almost a norm that we talk about in meetings now. And it's something that really captures our clients' attention, because it's so tangible and we can relate to it and talk about it with them every day.
I imagine or what we have seen basically is how it's not just a norm, but it's reinforced, it complements fundamental financial analysis, where ESG risk is ESG risks are or opportunities, but they have been externalities that market have ignored for a long time. Yet the world has shifted, and these externality needs to be internalized. It impact costs, it impact competitive positionings, and company that are able to talk about this in a data informed way and show how they manage and understand their company operationally and how robust it may be, can only give confidence in the fundamental financial numbers, that there is no, litigation coming up or huge cost or fine coming up. And so I think it is quite complementary, and now it is about, if not value creation, definitely helps build more resilient portfolios and a better view of companies. And Hanna, having, I believe, launched a few global funds in the past few years, ESG funds, any view on how or whether ESG have helped improve the risk return of that portfolio overall, and how it has changed over time?
Yeah, thanks. So similar to what Sarah said, we pretty early on also thought that, or found that investing in firms doing the right thing, so offering sustainable products or sustainable services, and also running the businesses in a sustainable way, those should be the ones that actually perform better over time. So with this mindset, we launched both a sustainable equity fund and a sustainable bond fund back in 2009. So that was quite early, and a lot of investors still thought about it more as from an ethical point of view, and back then we actually had a lot of questions around risk and return, and if you were not giving up on returns, people did not quite believe in it, and that you could achieve the same returns. And I mean, coming back to the traditional mindset that the larger your universe, the more opportunities you have. So by introducing an ESG framework, you do reduce your investment universe. And back then, a lot of the thinking was that, according to financial theory, you will lose out on returns. That conversation has completely turned, I would say, over the last couple of years. I haven't had any of those conversations for the last couple of years. So I think there's definitely been a completely change in the mindset of our investors. So we only speak with institutional investors. And I would say there it's, apart from what we're talking about in the beginning, with a few exceptions in the US, it's usually much more going into details and really wanting to understand your ESG framework and being fully aligned that over time, this should, if anything, lead to a better risk framework and also opportunities. You're muted, Adeline.
Apologies. I totally agree, and I was saying that it's worth taking a step back, even more so since you mentioned the US, where there is probably, and hopefully for those that are listening, it might be helpful, but ESG is sometimes misunderstood, where there is two sides of the coin. And what ESG data will help an analyst and investor do is really understand the operational efficiency of that company and how it is operational efficiency relative to its peers. It's not obviously about its product strategy, but it's about within that sector, comparing to mining companies. If one company emits twice as much carbon emissions than its peer, yet delivers the same results, but in terms of output, but we can obviously see with that there is one company that is twice as efficient and hence is probably producing that ore with half of the cost ultimately when amortized than its peers. It has invested in the right technology. So if both mining companies, or if an investor has a choice between these two mining companies, and choosing one only because maybe China is growing or something, well, it helps cherry pick understand better which company is better managed than the others. We can see that also with fatalities, for example, some key points that are relevant for that sector. But that's really more what ESG data helps do, is really understand, have almost a sneaky peek at the quality of the management and operational management of that organization. And then secondary to that, and complementing that ESG analysis, is about understanding, okay, we are looking at the cars auto sector. Okay, now so once we understand the for comparable company, which one is more operational efficient, the other side is, okay, what is changing the industry is greenification, electrification. And so who is investing most in the EV to remain or to lead competition over the next 5 years, because the industry landscape is changing, and hence the product allocation or product innovation is important, but that is not going to be captured by ESG data. This is a different analysis, which is more about company ESG strategic product strategy, and how what is important, where the demand is, and who is investing to remain competitive for the next 5 years. And I guess these two analyses, which are very different, are complementary. But ESG is definitely not about what often in the US the backlash comes from, where they think it's about ethical investing or preventing someone from investing in fossil fuel. ESG is actually as a ESG integration, which we are talking about today, at no point is about reducing an investment universe or judging a sector. It is about accepting all sector, but understanding within each sector what are these new issues that matters and who is doing better than others, which give a picture on operational efficiency. So I just wanted to take a few seconds to hopefully shed the light on this, and I hope it's helpful to our audience. And so moving on, because it's International Women's Day, we can't ignore that topic, which is definitely critical, and we have here a women-led webinar, so it's amazing and very exciting. And I'd like to ask maybe each of you today, Sarah, Hanna, and Anna, what do you think about, for example, diversity quotas? And it can be a 30-second view, personal view, perhaps, but the UK is introducing a new rule, which is moving from traditionally expectation of 30% of women on boards to calling for a 40% women quota. But in addition to this 40% women quota, the rule asks as well, would like to see a woman in a leadership position, which would be either a CEO, a CFO, a chair of the board, or a senior independent director. So this is quite exciting, I think, and it helps move the conversation of diversity or trickle it down within an organization a little further. So what do you think? Sarah, may I start with you?
Yeah, I think it's a really interesting quota to have come in, and I know in the EU that there's a similar quota, albeit without the reliance on the CEO, CFO position. And actually, interestingly, MSCI produced, I think in honor of International Women's Day, they produced a report covering 2022 about women on boards, looking at the MSCI ACWI. And there has been an improvement. There's been a marked change in the number of women who hold seats on boards. So almost reaching 25% in 2022 from 22.6% in 2021, which I think is a small change, but is moving the needle. But MSCI also highlights that companies with a higher percentage of women on boards also performed better on all of the 3 E, S, and G pillars. And studies have shown that female corporate directors are more likely to prioritize long-term societal issues like climate change. So I think even though people will have mixed opinions about a quota in the UK or elsewhere, it is interesting, and it's helpful to bring these issues to light, because it starts to progress the narrative a little bit. And I think as long as these changes are done on merit and ensure that the company is still performing to the best ability that it can, then I think it's an interesting change, and it keeps the conversation going.
Thank you. Hanna, any thoughts on quota, diversity quotas?
Yeah, well, I think it would be much better if we didn't have to put in quotas, if we could just do it because it's the right thing and it makes a lot of sense to have diversity. I mean, there's so many studies showing that diverse boards, diverse companies perform so much better. So it should be done automatically, but obviously we don't live in that world. So for that reason, I still think it is good because we need to push forward. We're making progress, but it's very slow. And I think we now have good examples where quotas have worked really well. And the kind of critique that it received in the beginning, that it would only be the same women being on all boards, you didn't have the right qualifications. I think it has been shown that that's not an issue. There are a lot of very, very qualified women out there. So yeah, to get started is the wrong word, but to push it further, I think for a while we're going to need it. And hopefully one day, not anymore. It would just be part of with so many other things, it will be part of what we do. But for now, yeah,
it's a kickstart.
Yeah, exactly.
And any view?
I can only agree with Sarah and Hanna. It's a bit nonsense that this is needed, but I think this will. It's a transition phase, right? This will make sure that we are moving forward, and 10 years from now, hopefully, we will be in a better position and laugh about how silly we were before.
And so, can I ask maybe, perhaps I would say Hanna, because I believe you vote at AGMs. So how do you embed perhaps ESG within your investment process? And for example, as an example, do you vote against a board that don't have enough women?
Yeah. We do. So overall, we actually follow the ISS SRI policy guideline when it comes to proxy voting. And they have pretty clear criteria when they vote against. They don't vote against the board, but they vote against the nomination committee. And I think it also makes sense what the way they do it, that it differs depending on where the company is based. They have different criteria. So for example, for a company based in the US, they vote against the nomination committee if they don't have at least 40% of underrepresented groups. Whereas, for example, in Japan, that would look different. So it's a range of different criteria for different regions. And as said, if they are not fulfilled, they would vote against the nomination committee. What we have decided is that we actually only vote against the chair of the nomination committee, because the nomination committee itself is usually quite diverse. So we don't want to vote against the whole committee, but vote against the chair in certain cases. So I looked at the numbers, and I think last year we voted against the chair of the committee in 80 cases. And those were mainly in the US and some in the UK as well. And I think, I mean, this should then also be combined with engagement. So for the companies that we look at, it should start with engaging and having that dialogue that we don't think the composition of the board is sufficient, and that they should think about improving the diversity. But then I think this voting is also an important part of it.
Thank you, Hanna. Anna, may I maybe turn to you and ask, aside of the maybe investment process within your organization, you have, I believe, a female CEO. Could you maybe share with us how does your company internally seek to improve diversity? Any best practices or ideas you could share?
We do. We recognize the value of diversity, not only gender diversity. We understand the risks of not being diverse, both in terms of our investments, but also in terms of the attracting employees, right, and being an attractive employer. And this comes from the board, but also within the company. Looking at private markets, notoriously bad at diversity, but we're quite decent here. We have 40-60 gender split at CapMan and 38-62 in the management group. But on partner level and in the investment teams, it looks different. So I think it's important to work on this on all the different levels, right? Not being satisfied with 40-60, because if it's male dominated at partner level, that's a different story. So to address this, we are this year we have created a diversity, equity, and inclusion working group, and we have a sponsor from our board. The working group, they're tasked with finding concrete, actionable solutions for CapMan, both long term and short term, because some of these problems we won't be able to tackle all of them in the short term, but we also want to be part of the solution long term, more societal level. So the group will help the management team. They're briefing us semi-annually, and then we will take measures that is kind of agreed upon throughout CapMan. So I think we've also implemented things already with our when we're hiring. So a 50-50 split, for example, as the last candidates is I think a quite good measure to take.
Yeah, absolutely. I guess the key is really finding ways to make sure that diversity trickles down across the organization, and to share actually a report our group, our team from Bloomberg Intelligence published today. We published actually several notes and reports on for International Women's Day, and looking at basically the key diversity trends and results. And for example, looking at US, Europe, and APAC, what is common across region is that most diverse companies actually have lower volatility than companies on the bottom side of things. However, from a return perspective, it's a little bit different in different regions. In the US, there is less correlation with return, but in Europe there is, and that's quite interesting. Maybe because some markets are actually more diverse, so it doesn't reflect as much as an outstanding metric, whilst in a market where there is still progress to be made, such as in Europe, then maybe that is a vector. And what we did find that herboarding remains an issue, for example, in APAC, and we shed the light on this, and hopefully in some region or listed markets such as Hong Kong, it is because of a significant challenge there, some new rules we try to tackle the herboarding to actually, as you said, Hanna, there is a lot of women, a large pool of women, very qualified, and so hopefully it is shared amongst women as well, across the board, and maybe some sponsorship and mentoring opportunities between men and women in different organizations can, for example, help drive such a spread of diversity. We find. So moving back to ESG and ESG investing, I guess maybe one question to each of you is basically what are you struggling with from an ESG integration perspective? And we see that there is, for example, increasing scrutiny, in particular from regulators as well. So maybe if each of you could give us a view, starting with Sarah, then Hanna, then Anna, like what you're struggling with and what do you need today from regulators, perhaps?
Yeah, it's a very good question. I think in terms of struggles, broadly, the one that's been a continual point for us is data availability versus data quality. And over the years, data availability and quality have got better for certain metrics, things like carbon, scope 1, 2, and 3. There's a lot of data now from quite a lot of companies that we get. And it's the narrative is shifting slightly now, where we're trying to consider additional factors. So whether it be biodiversity metrics or diversity metrics that we've talked about already. So it's that availability and then the quality that we can use and manipulate data. Another struggle for us is ensuring a consistent and helpful dialogue with companies when we engage with them, because I think a lot of companies are now facing an enormous amount of whether it be questionnaires from MSCI or Sustainalytics or regulatory filings they've got to do. So there's a huge burden on every company now with respect to regulation. I think that we're all struggling with that. Internally, obviously, we have to consider as a firm, and for us as a small firm without a huge sort of team of resource for this, our own regulatory needs, and also those the companies we invest in. So trying to keep on top of the various jurisdictions that we invest in. So in the EU, it'll be SFDR or the taxonomy. In the UK, we've got the impending SDR rules. So there's lots of different moving parts. And I think the hard part is trying to maintain our ESG integration, our voting, our engagement, and our active ownership of clients' assets, whilst keeping on top of the regulatory hurdles that are coming up for us and also for our companies.
Imagine maybe one thing that we could like from regulators today is probably more harmonization across those
Absolutely.
rules. Hanna, what about you? What are you struggling with, or your organization?
Yeah, I think obviously not completely different to what Sarah said, but I think one observation and what we're working on quite a lot now is this Scope 3 emissions, where it's very relevant for a lot of the frameworks. You have to look at it in SFDR, within TCFD, SBTI, Net Zero Asset Manager Initiative. So there are a lot of initiatives and frameworks that kind of push you into that direction. And we also know that it's very relevant. So of course, it's something that should be taken into consideration. But if you look at the data, and we actually just did a bit of a study on it and received data also from others. And out of the MSCI all country benchmark, 40% of companies are reporting on Scope 1 and 2. So already that is quite low. And then if you look at Scope 3, it's only 25%. And what we observe on the Scope 3 reporting data is that companies usually pick what's easy for them. So for example, traveling, that's something that they report on, but that's usually, or for many companies, if it's a real estate firm, that's a very small part, and it would be more relevant to measure other parts of their Scope 3 emissions. So I think that's one part where we still need better data. I fully agree that data has really improved over time, and we have much more to work with today. And it's definitely nothing that should stop you from getting started. But I still think that's something where we need to see even more progress going forward. And then I think the other part, which we also found quite interesting now, if we look at the EU with the sustainable regulation, that they started with regulating investors or financial industry and kind of putting frameworks into place and regulations on how we invest. But in the end, we really need the companies to change because that's our investment universe. If the companies are not changing, it will be very difficult for us as investors. So you definitely need both. And we see that coming as well. You have regulations for companies coming up as well. But I think that's a very important part to move the industry forward. In the end, we need real world change and not just moving our money away from the bad ones.
Yeah, and hopefully regulators and peer pressure will force companies to go in that direction, of course. And Anna, could you share with us maybe struggles from the private equity world and maybe what you would like to see from the regulatory environment that applies in particular to your business?
Yeah, I think I can start with saying that the regulatory changes that are being pushed from EU, I really appreciate them. I think it's made a world of difference. in the entire financial industry. I think there is a clear before and after, and even though it's not perfect, it's making it has a big impact. With that said, we're also, as everyone else, struggling with it, and I think specifically for us as private markets actors, it's not necessarily tailored to our type of business. So understanding what it means for us is challenging, and guidance there would be appreciated. But I like that there isn't too much guidance, because it means that it forces us to really think about what it is that we are doing, and it forces us to make the difficult decisions. And I think that's healthy for a financial institution to be put in this position, basically.
Yeah, I couldn't agree more that reg is not perfect. However, it has set some basis, and I think or it's helping, or it will increasingly help the market be genuine and have more robust product offering, less greenwashing, and hopefully
it was quite clear that you could get away with quite a lot of things. A few years back, and
exactly. And now we are seeing an increase in litigation against corporates, but also against investors. And I think it's a very welcome trend. And hopefully that risk, not being in the front page of Bloomberg News or the FT or else, is something that will force investment managers and company to take this very seriously, and not just have very high ambitions with little to say to back it up. And in the private world, I guess, hopefully there is more to come, in the sense that maybe sometimes listed assets go in the private world like very like say coal assets, and people have been praising about coal exit, for example, but the other side of the medal is that maybe a listed company divests from its coal assets, but then it doesn't mean that this coal asset is closing down. It's not out of the system or of the equation. It's just going into maybe a private, the private world, where there is less scrutiny, unfortunately, and this is, I think, a real challenge that hopefully over time can be addressed, and that the market can understand. And that raises the questions that we got from the audience, which is, what is better, active engagement or divestment? I guess, in my opinion, but happy to hear from the panel, active engagement is always better, because divesting from an organization is not going to incentivize that organization to change, to drive change, and there is less scrutiny. And that's kind of the same with what for asset divestment. If any one of you would like to comment on these questions, please go ahead.
I think it's, I agree to what you're saying, but I think you also need to think about, or take a little bit of a step back, and as an investor, think about where you want to put your money, and with your money, what you want to support. Because you can keep your money in coal and say that, well, I'm an active owner, I'm pushing for change here, and that's a strategy that you can have. You can also put that money into green energy and financing that market. So it's about what it is that you want to accomplish. But just divesting, I mean, that doesn't really mean anything, right? But you need to have a more comprehensive strategy around it.
Yeah, and I would say, actually, to complement that, active engagement needs an outcome. After 3 years of engaging with the companies, if there is zero progress, there should be a consequence. Otherwise, we can remain engaging for a long time with little to show.
I think what Hanna said before as well on voting, the combination of voting and active engagement is more effective, I would say.
Absolutely. And so that maybe takes us to maybe the last part of our panel, which I hope everybody found insightful and interesting. But can I ask maybe each of you, what do you think is the most significant change in ESG investing in the next 5 years? What are you the most excited about? What do you think are going to be the biggest, or what would you like to see for this space in the next 5 years? Maybe 30 seconds each. Sarah, would you like to go first?
Yeah, I'll try and keep it short. I think you touched on a couple of points earlier, actually, when you highlighted the scrutiny and the litigation that the companies are going to come under. So I think that will continue, and I think that will help investors and consumers get a bit more information and accountability for companies. We've seen Client Earth in the last few weeks, taking Shell board of directors into account, and they've taken governments to court. So actions like that, I think, are going to increase. I also think, going back to an earlier point I made about the harmonization of various metrics and understanding that climate change is not a standalone crisis. It is very much linked to biodiversity. It's very much linked to social mobility and living standards. And I think that if we can get more cohesion over the interrelated nature of these and more information on biodiversity metrics, for instance, that would be really exciting for me.
Now, what about you?
Should I continue? Yeah, I think we'll definitely see more and more transparency continuing with data. And what I hope for, and what you already see now, is that consumers will be much better informed and make decisions based on that information. Because I think today, as a consumer, it's not always easy to know if you're when you buy products or whatever, if that's really a sustainable choice. And I think that's where we see a lot of innovation coming now, so that consumers can actually act and really buy and put their money in companies that they think produce better products or services. And that's then really going to affect the bottom line of companies as well. So I think that's one of the developments that I'm hoping for.
Empowering clients. Thank you. Anna, last but not least.
Yeah, I think what we are experiencing now is a transformation of the financial system, right? So 5 years from now, that's quite a long time. So I'm eager to see how far we have gone then, but I think Nature Positive will be standard understanding, like for companies to stay relevant and to be relevant in the future, fully understanding their impact on the world and the world's impact on them, and having a holistic view, I think will be hopefully will be mainstream in 5 years.
This is a very nice way to finish our conversation today on a very high and positive note. So thank you, Sarah, Hanna, Anna, for a great conversation. I definitely enjoyed it, and I hope everyone in the audience did as well. Again, thanks everybody for joining us today, and we look forward to see you on the next webinars. And if you have any questions, please do reach out to any of us. Thank you again, and have a great International Women's Day. Bye-bye.